So I think someone who's listening to this would say, okay, that's great. But how are you guys positioning your accounts? What are the things that you're doing? Some of you probably got some notifications earlier this week about investment changes in your account. John, what are just high level, the couple of areas that we are making movements in investment accounts?
Yeah. So a couple of things that we're doing, recognizing interest rates are moving up, then value of bonds are going to go down. We have decreased bond market exposure across the board in accounts. And so what that means is the longer the maturity of the bond, the more volatile it is. So we have either decreased the maturities into a very short maturity. So if interest rates go up, well, then the interest rate we earn inside that really short term of really a year or less fund would actually go up with that. Or we've utilized some rising interest rate funds that have the ability to float up if interest rates go up. And the third part of this is we begin to incorporate what's called target outcome ETFs, in which we have some option strategies inside of those ETFs that we're using as a replacement inside bond portfolios that limit us on the downside, but still give us appreciation potential on the upside. So on the protection portion of your portfolio, we have changed the allocations to decrease risk due to interest rates. As far as in the equity portion, the stock market portion, we've also made adjustments for a rising interest rate environment and also an inflationary environment. And so, as we said before, in every economic cycle, pretty much as the economy moves up and down, there's different winners and different losers. And so, whenever we're in an inflationary environment in which we have a higher interest rate, a rising interest rate scenario, in those areas, we see areas such as a dividend growth stock with the companies that have a history of increasing their dividends every year for a minimum of 25 years, with a strong cash position of the company and a low debt position. Those types of companies thrive in that environment. And so we've reallocated dollars into a couple of ETFs that really focus in those areas. We call those dividend aristocrat funds. And one of them has an option strategy tied to it also to limit us some exposure on the downside. In addition, we're also going to individual equity positions on the dividend players that have the ability to grow their dividends. And so you'll see those changes in dividend players. We've also added in some small company value stocks that do very well in a rising interest rate environment. And we've decreased exposure into the large company growth because, as we know, interest rates go up. That hurts large company growth because many of those, the growth is fueled by borrowing costs. And so those are some of the changes we made across the board to position portfolios better in 2022, just for the changing economic environment that we're all living in.